Good afternoon. It's Saturday, October 8th, 2022. It's just after noon on the East Coast. This is Robert Sin at CEO Technician on Twitter, at Goldfinger on CEO.ca, doing my weekend video. These videos have been lately taking an hour to complete. I have a feeling this one's also going to be an hour. There's just so much to digest and talk about in the world today. And I want to start this conversation by offering some non market focused thoughts, a reminder to practice gratitude on a daily basis. Take a moment or several moments or minutes to think about what you are grateful for and to, remind ourselves to do things that make us happy. Um, if something is making you unhappy and affecting your mental or physical health, then stop doing it. Change your thoughts, change your actions, do what makes you happy, and always come back to gratitude. So I'm going to start just reviewing my Twitter stream. I guess some people like to look at my Twitter stream as well. Um, that's another topic. So we start with this tweet from yesterday. So this is EQX. Okay, this is Equinox Gold. Ross Beatty, billionaire mining investor, one of the most successful investors in the history of the mining sector, is a 7.7% shareholder of this company. So he's pretty heavily invested in Equinox. And this tweet just simply showing the chart setup that typically, if this was the bottom, then this is a classic pullback to support, following a very powerful thrust off the bottom. So it's not exact. It could be 350, it could be 360, it might even be 340, but somewhere in this area around the 350 level should be the end of the pullback. If, big if, capital I, capital F, that was the bottom. If that is not the bottom, or that bottom needs to be retested, then it's going to just go right through it and come right back down. So we should know early next week if this chart interpretation is correct. And it's very important to understand technical analysis is not about having a crystal ball. A lot of people have this misconception that you need to look at the chart and form an opinion of what exactly is going to happen in the future. Only one opinion. It's either going up or it's going down, and that's it. It's bullish or bearish. Can't have a opinion that's more nuanced. And in reality, technical analysis is about probabilities and identifying higher probability setups where the risk is lower relative to the potential reward. And that's really all it is. It's not about having a crystal ball. And this is very important to understand. Charts morph. They're constantly shifting, shape shifting. Patterns are forming, patterns are breaking, patterns are breaking out and then failing. There's all this morphing going on, right? It's constantly shifting. It's not stationary, it's dynamic, it's transitory, just like everything else in life. It's transitory. So to see this pattern as an experienced technician, I see this pattern and I say, this is an interesting spot where the support could hold and the upside could be substantial if the interpretation that this September 26th is the bottom is correct. But at the same time, I say that in the next breath, I am open to being wrong, that the support won't hold and this was not the bottom. And that's where risk management and position sizing comes into play. And if we go into that subject, this video will be 6 hours, not 60 minutes, right? But Equinox is on my radar and I am long for a trade. I went long at the end of last week for a trade. So that trade could end on Monday or it could end a month from now. I don't know, right? And so any stock I talk about, you could assume I'm long, and you could assume that at some future date, I may choose to buy or sell at any time without notice. That goes, without saying essentially. Cue the Black Monday tweets. Friday was an awful trading session. This poker cheating scandal. It's really interesting. It's like a Sherlock Holmes case. That's a whole nother story. Credit Suisse. So last weekend, financial Twitter was ablaze in Credit Suisse. Is Lehman 2.0. We've had a potential Black Monday literally 4 weeks in a row. Like this is like the fourth potential Black Monday that we're walking into, with just how poorly stocks traded on Friday and how they closed on Friday. And then, either it's a nuclear war headline or it's Credit Suisse is failing, Lehman 2.0 headlines. There's just these doomsday headlines, one after the next, that the market is being hit with. But interestingly enough, Credit Suisse rallied hard last week. It was up pretty big. And on Friday, which was an absolutely dreadful day for the broader stock market, it was up 13%. So interesting. And this is just yet another example of how social media, especially Twitter, is filled with really lightweight thinking, no depth, and just this herd psychology. Everybody gets on a meme or a tweet and they retweet it because it sounds good, right? Or they think it's going to be popular. It's not about any factual, analysis or deeper analysis or deeper understanding of anything. It's just about rumors and memeing and creating a frenzy, whatever the frenzy of the day is, right? And last weekend it was Credit Suisse, and I haven't heard anything about Credit Suisse in the last few days except for the fact that it was up big on Friday. This is interesting because I did this poll on Tuesday after the market had been up 2 big days in a row, and most of my followers said that is a crack pipe rally, basically calling it a bear market rally. It was going to not last. And sure enough, they were right. Uh, Basically, stocks almost completely retraced the entire Monday, Tuesday rally. Bizarre market action last week, really. 2 weekends ago, I made a video titled Nobody Knows Anything, basically saying that nobody knows what's going to happen in this market. Really, nobody knows, including me, especially me. Okay. Nobody knows anything. And, you could be bearish on Friday, you could be bullish on Tuesday, and then bearish on Friday again. That's literally how crazy this market is. And it has no memory day to day. Margin rates. So, this is a big deal because these margin rates are very high. I mean, we're talking 9 or 10% margin rates. That's a very high interest rate. And this is basically forcing people to get off margin, if they know what's best for them. And so we're seeing these interest rates go up across the economy. I mean, you need to put this into perspective that we have been living in a very low interest rate or zero interest rate environment for the past decade. This is a chart of the 10-year note yield. You know, you can't argue this anymore. Bond bulls have to kind of just, um, admit they're wrong here. This is a very powerful move up in treasury yields, and it's affecting everything across the economy. Mortgage interest rates, 30-year fixed up to 7%. Margin interest rates, even if you have $1 million debit balance, you're paying 7%, right? So this is oppressive, uh, interest rates, and this is going to affect. This is creating a de-risking across all markets and asset classes, and it's going to cause people to rein in their borrowing. Simple as that. Um, so the weekend Barron's cover, I feel like I was one of the first to post this morning, and now everybody is posting it on their Twitter timeline, especially in the gold community. And yeah, usually when Barron's runs a cover like this, it's a negative for whatever they put on the cover a few months or a year out. I mean, there's probably a pretty damn good chance that a year from now the dollar is going to be lower than it is this weekend. But I would not call it an exact timing tool at all, but it is a notable piece of sentiment. It's like, a bit of like an anecdotal piece of sentiment data that Barron's, the dollars had such a strong year in 2022 that Barron's has George Washington with a bodybuilder body flexing on the cover. I mean, you can't make this stuff up. And I guarantee you at the New Orleans Investment Conference next week that somebody, one of the presenters, is going to use this in their presentation. I mean, it's just too good. And I almost feel like Barron's does these covers now just to get more attention. I mean, they're playing with us at this point. I mean, seriously, they're playing with us just to get more readership. And it's clever. It's clever. I don't know what's going on in Moscow today. I'm not even going to comment on that. Elon Musk. Okay, Elon Musk. So this is the final topic of my Twitter stream. Elon Musk. Where are you, Elon? This guy. Okay, so I feel like Elon's not having a good month of October. He's being forced to buy Twitter, basically. Forced. I mean, he agreed to buy it, but now he's being held to his agreement. Um, so coughing up, what, $44 billion or something to buy Twitter. His stock is getting hammered in the last several weeks, down from over 300 to a 223 close on Friday, down 6.3% on Friday alone, down big last week. I mean, look at Tesla just last week. It gapped down on Monday while the rest of the stock market was up. And this is basically in a crash. So I mean, look at Tesla, folks. This is notable. Tesla was one of the bright spots in the market in August and September. It was holding up while other things were rolling over or just sort of at their lows or hanging out near their lows. Tesla was displaying relative strength. Well, no more. In the last few weeks, it's completely fallen apart. And last week, notable relative weakness from Tesla, down significantly on the week. And they have earnings coming up. I think earnings not next week, but the week after, if I'm not mistaken. And then he's like, so the whole Twitter thing is a big distraction. Now he's trying to play peacemaker between Russia and Ukraine. And then this morning I read he's offering a proposal that Taiwan should give up some control to Beijing in order to ease tensions. I mean, what? First of all, he's way out of his sphere of influence and just completely off the reservation here. And second of all, his ideas are basically non-starters. Taiwan is not going to voluntarily give up control to Beijing to ease tensions. Uh, it's clear to me he's trying to win favor with China with these actions. And I wonder why. You have to think like, what's his motive? Like, where's the incentive here? And he's trying to pose as if it's altruistic. He's trying to save lives, trying to avoid World War III, yada yada yada. But in reality, I feel like this is a move on his part to help Tesla's sales in China. And actually, I'm not a Tesla expert by any stretch, but I can just look at the earnings forecast, the growth forecast from Wall Street analysts. And I mean, they're expecting EPS growth averaging 55% over the next 5 years. That's enormous growth. There's no other company on the planet with anywhere near a market cap like Tesla's with this kind of growth expectations. So a lot of good news is baked into this share price. And based upon the way the market traded last week, my guess is that people are getting an idea that this coming earnings is not going to be good, and Tesla's not doing great, and they're going to miss on some of these growth forecasts. They're going to lower guidance. That would be my guess, just knowing the stock market and just how horribly Tesla traded last week, and the way that Musk is trying to win favor. I mean, this is so obvious. He's trying to win favor with China here. And China is a big potential source of growth for Tesla over the coming years. So that's my 2 cents on that. Um, Trevor Hall at Mining Stock Daily had a very good long form interview with Rick Rule. Take a listen to it. And one of my sort of key takeaways from this conversation is just how big of a mess the US is in terms of the debt and the unfunded liabilities. I mean, the numbers are astronomical. I mean, they're so big, I can't even wrap my head around them. I think the unfunded liabilities total something like $140 trillion. Trillion dollars. So the national debt is somewhere around 31 trillion. But the unfunded liabilities, that's a whole nother area. Medicare, Medicaid, et cetera, et cetera. All these promises, essentially, liabilities the government has to the American people totals, 4x, 5x the actual national debt. So the number is so big, there's no possible way that we can pay for it. I mean, there's just unless we we find some planet that's made of gold or something. There's no way to pay for it, right? And so, Mr. Rule has some interesting comments about how the government may attempt to bridge the gap over the coming years. And one way is to take more wealth away from the baby boomers. No, I don't know how they would do this exactly. Some sort of taxation or death tax or wealth tax or something. Basically, the populace, the voters who are not wealthy, will vote to take money from those who have wealth. And the baby boomers have most of the wealth in this country at this point, right? So that's an interesting thought, and it makes a lot of sense. This is what happens. The poor are the more populous group in society, the middle class and poor, and they have the votes, and they can vote as they please, right? They can vote for politicians that are wanting to share the wealth and seize it, right? But so that's a whole other topic. But something like that, or something similar to that, could definitely play out over the next decade. Um, but more importantly, in order to deal with all these debts and liabilities, the currency is going to have to be weakened, and there's going to have to be inflation. There's no other way. I mean, if there's no inflation or there's deflation, then the situation becomes even more acute and impossible to deal with. So, inflation and currency devaluation has to be part of the plan here, for how to kick the can and how to keep this game going a little bit longer, right? And I think somewhere in there, either in this idea that we're going to seize the wealth of the baby boomers, or there's going to be currency devaluation or revaluation, that inflation is actually part of the plan and not the enemy that the Fed is making it out to be right now. I think in there is your long-term bullish thesis for gold and silver, um, and wealth preservation is the game, right? So you don't buy gold to get rich. You invest and own gold to preserve your wealth and your purchasing power over time. And I think that theme is going to come back into focus in 2023. Maybe it's a little bit early here. It's a little early still, but I think that theme is gonna come back into focus here. So listen to the Rick Rule interview; it's very good. So, cover of Barron's. Here's the chart: the dollar, just the dollar wrecking ball of 2022. Um, you can't you can't really make a bearish case on this chart. It's a very clean, strong uptrend. It started to turn parabolic at the end of September, but then it had a pullback, and now the uptrend is resuming. So while I feel like the Barron's cover is a sentiment, indicator, it's a contrarian indicator. I think it's a longer term one. I don't think that you go out and just short the dollar on Monday. I think the dollar is probably in a topping process for the rest of this year. And it will really be when the Fed, uh, waves the white flag and says, okay, we're pausing, and hints that they're really done with the tightening, that you're going to see the dollar roll over. But with another 75 basis point hike teed up, for November, I mean, the probability is over 80% that we're going to have a 75 basis point hike. Now, obviously, this is a moving target. We've got a month to go. This could change, but if I'm a betting man, which I am, odds are it's going to be 75 basis points in November. And then you have this parade of Fed speakers that are saying they're going to 4.5% by year end. So right now, the base case is 75 and then 50 to end the year. And we get to 4.5% on the Fed funds. And then we see what happens, right? We see what happens. Good chance, and this is some more and more people: Kyle Bass, Scott Minerd, some smart guys, Hugh Hendry, smart people, basically saying that something's going to break if and when the Fed gets to 4.5%, and it could break really fast. So that's another sort of feather in the cap of the bullish case for gold. When stuff starts to break in the financial system, that's often when gold really shines, right? And there's so many things that could go wrong in the world today. It's like one of them's got to happen. And unfortunately, part of being a gold bull, gold bug, gold investor is you're sort of contrarian to the financial system. You're sort of in a way you're betting against the financial system. Um, but yeah, that's another aspect to the gold bull case is we're getting close to the terminal rate. I mean, a lot of people think that 4.5 is the terminal rate. And if it is, well, we're there by the end of the year. We're there in 2.5 months. And then a lot of really smart people saying they think the Fed is going to break something here in the next few months as they put in these final big rate hikes that just the markets and the economy have not been trained. They're not accustomed to handling this speed and such an aggressive rate hiking cycle, the most aggressive since 1980. Um, Waller. So this is I suggest reading Bostic a speech on the 5th and Waller's speech on the 6th. Bostic would be a little more dovish. Waller's a little more hawkish. But Waller's just basically laying out the case that we're not pivoting and we've got to keep hiking. And we don't care about housing. The housing prices need to drop. And he goes into some detail explaining what led to the housing price appreciation in 2020 and 2021. And I believe, based upon reading this, the Fed would be totally fine with seeing a reversal of all of the post-pandemic housing price, rises. Um, and if we look at the stock market, look at IYR. Okay, this is the REIT ETF essentially. 52-week low on Friday, and then pull it out to a weekly chart. I mean, the IYR is basically given back all of the pandemic gains. It's actually given back more. I mean, if you say the pandemic started in February, well, the IYR was up here, we're down here now. So the stock market, which is definitely a leading indicator, definitely. Housing, actual physical house prices move relatively slowly, and they take months to catch up to what's actually happening in markets. It's a much slower uh, transaction cycle, right? It's saying that housing is going to crater here in the final months of 2022 and early 2023. And I've read various forecasts. Basically, they think that housing prices national average are going to drop another 15% between now and the end of 2023. And that's like the average forecast. The bear forecast would be more like 25 or 30%. And I can tell you that if housing prices drop 15%, well, the economy is going to be in a recession, period. I can tell you that for sure. And if they drop 25% on average nationally between now and the end of 2023, the Fed is going to have to be cutting rates because that will have a deflationary effect across the economy. That will have a very negative wealth effect and a deflationary effect if the housing price drops are so severe. But eh, look at XHB and look at IYR. I mean, these are telling you that what Waller's saying is happening, that housing is going to roll over and it's going to roll over really hard. And people who think that they have a certain amount of equity in their home, well, take 20 or 30% off that very soon. It's not real. It's not real. So people are not as wealthy as they think they are now, right? And so this is going to have um, a spillover effect across the economy. It's going to cut consumer spending. It's going to reduce travel, et cetera, et cetera. It's a knock-on effect, right? Housing is the keystone, the backbone of the U.S. economy, of the North American economy, Canada too. It's integral. Um, Bostic had some really interesting comments about how he thinks that there's lag effects from monetary policy, and that they shouldn't just keep hiking past 4.5%. That somewhere between 4.5% by the end of the year is where they're going to get to, and then they should hold at that level and see how the economy reacts. I do not think we should continue raising rates until the inflation level has gotten down to 2% because of the lag effects. This would guarantee an overshoot in a deep recession. So he's literally saying this would guarantee an overshoot in a deep recession. That's pretty strong words. Yeah, that's pretty strong words. And this is the Atlanta Fed president. Yeah, he leans a little bit on the dovish side, but I think his words matter. But we will need to see other Fed members share similar concerns, or else he's just going to be sort of the dovish outlier. That's not how uh, the FOMC is actually thinking. We talked about the 10-year note yield. So that yield started going up again last week. Stocks can't bottom until the 10-year has peaked. I mean, I'm very confident in saying that. I mean, if the 10-year is going above 4%, the S&P is not going to find a firm bottom. It's really that simple. We need to see uh, sort of a moderation. Just it'd be okay if it just stopped going up. Um, but for stocks to really rally, I think we need to see yields roll over, and that would most likely mean the dollar is rolling over. So this is a 30-minute chart of the E-mini S&P. So this is showing the end of last week, and this is obviously where the jobs data came out Friday morning. Big red down bar between 8:30 and 9 a.m. And basically you can see a trend lower session. So the fact that it couldn't even make a rally back up to this blue line, this downward sloping blue line, which is the 14 period, moving average, um, not not good. Bulls had no ammo on Friday, so it was selling from the open all the way to the close. We call that a trend down day. And if we pull it back to a daily, it almost gave back all the gains for the week, almost, but not quite. Last Friday, the S&P closed at 360150. So this Friday, about 50 points above that. Uh, so one way to look at it is, well, Friday's action was really bearish and a sign there's more selling to come. Another way to look at it is, well, stocks traded pretty poorly on Thursday and Friday to finish the week, and they still closed up for the week. And if we put it into context, 2 Fridays ago, we were walking into a weekend where there was nuclear war talk and there was Lehman 2.0 talk. And the fact that we couldn't make a new low with all that negativity, well, that's a positive sign. So there again, nobody knows anything, and it's absolutely not clear, um, where markets are going. If you're a trend follower, just simply look at the trend. We're still in a downtrend. Way too early to call a bottom. Keep it simple, stupid. Sell rallies until further notice. And if you just stuck with that simple thinking, well, then you sold on Tuesday or Wednesday, and you did well. Another point I want to make, and I kind of wanted to make this at the beginning of the video, but I'm going to make it now, is that as a trader, you're very fortunate because you don't have to do anything. You don't have to trade. You don't have to be long. You don't have to be short. You don't have to be anything. And you don't have to stick to one opinion of what's going to happen. You can change your mind. You can be flexible. You can take a week off. That's one of the great blessings and huge advantage of being a trader. There are people, fund managers, portfolio managers, pension fund managers who have to be long. They have to be in the market. It's their job, right? Um, but we don't have to. And so if it's not a good environment, which I would say Friday was not a good trading environment for the most part. I mean, obviously there were some short setups early in the trading session, but overall, not a great day to be trading, and certainly not a day to be going long. Um, just walk away. You don't have to. You don't have to have an opinion. You don't have to put a trade on. You don't have to have an opinion every day. Um, Sometimes doing nothing is the best. And wait for the really good setups. And I think that patience is a virtue, and patience is definitely a virtue in this market environment as a market participant. This is something I talked about in last weekend's video, and even posted a chart on Monday or Tuesday saying, man, I hope it gets a little above 115. So it's a really juicy short setup for the pound sterling. It didn't get there. Literally within an hour or two after I posted that chart, it started to roll over. So this is a classic bear market rebound. It was a big rebound, 1,000 pips in the cable pound sterling against the dollar, 1,000 pip bounce, quote unquote. But this is a very weak currency. This is a very weak chart, and I would not be surprised at all to see sterling revisit these 104, 105 lows from September 26th. I would not be surprised at all. And if that happens, we're going to see more intervention from the Bank of England, more QE, you could call it QE, YCC. They're going to be intervening to support the gilts market, the UK debt markets, to try to keep yields, longer dated yields for UK debt in check. I think that the more intervention that central banks like the Bank of England have to do, the better it is for precious metals. So that would be another feather in the cap of a strengthening bull case for precious metals. We talked about IYR, XHB, talked about Tesla earnings, how it looks like the market's gearing up for Tesla earnings to miss. Look at the revisions in EPS year to date. So analysts are revising earnings estimates lower. So we're going to get a Q3, earnings starting to come up this week, and we'll have a slew of earnings for the next month across all sectors. Well, it's looking like this is not going to be a great season of quarterly earnings. Talked about Tesla, talked about the S&P. Again, when the relative strength index is at 38 and you're in this strong of a downtrend, it's not a favorable environment to be taking swing longs, right? You can take tactical longs on like an intraday basis, maybe little overnight trades, just quick buy towards the end of a session, sell in the morning, stuff like that. But bigger picture, this is not a favorable technical environment to be starting new longs and to be trying to call bottoms on stocks. It's too early to call a bottom. QQQ, same thing. And actually, so tech got hit harder than other sectors of the market on Friday. Tesla probably has a lot to do with it too. But this is a sign that this higher interest rate environment, you saw the mortgage rates, you saw the margin rates, you saw the 10-year note yield chart. We're in a higher interest rate environment. And when interest rates are higher, the risk-free rate is higher, valuation multiples are lower. And generally speaking, tech has higher valuation multiples than other sectors of the market. Well, so they're taking a knife to those multiples, and we're seeing tech lead the market lower. Gold miners. So we're sort of wrapping up this video, getting into sort of my wheelhouse of precious metals and gold miners. So this September 26th low is noteworthy. Number one, we gapped down into making this low and we gapped up out of it. And this was a more than a V-shaped bottom. So if I paint the whole picture, the sentiment backdrop, how poorly gold miners have traded this year, all the evidence, it's all the key ingredients for a major capitulation bottom in precious metals and mining stocks were in place on September 26th. The way that this bottomed in such a powerful V shape is encouraging. That doesn't mean, so let me go back to the start of this video. It doesn't mean that I know the future and I know 100% that this is the bottom and gold miners are not going to go back to this level or lower. But what it does mean is, in terms of probabilities, I believe the odds are better than 50% that this was a very important low, one that should hold for at least a couple months and maybe even longer. And also, kind of like I said earlier, when I was looking at the chart of EQX, we should know pretty soon if we're starting a new uptrend, because the pullback shouldn't be too deep and it shouldn't last very long. Maybe 3 days, maybe 4 days max, and then we should start moving up again. If we keep rolling over next week, then we'll know, okay, bear market rally. It really is that simple. The fact that we went from under the lower Bollinger Band to outside of it, above it, in literally not even a week, that's a very strong thrust. And it's the sort of thrust, the strength of this thrust is characteristic of an important market low. And I'll just leave it at that. Silver. Silver has a well-constructed chart pattern bottom on the daily chart, and silver bottomed at the end of August. So silver has been the leader here, and silver has constructed what looks to be a very formidable chart pattern bottom. And just like I said with the gold miners chart, the pullback is totally standard, the one we had in silver at the end of last week, from about 21.30 to 20. The $20 area should act as support now. So far it is. And if this is really a real deal bottom, silver should start to move up again at some point next week. Gold rallied back to a key level 1738. You see here. This is from a chart that I made a few days ago showing this level as sort of a key pivot point. I expected a pullback from 1738. We got it. Now, important support between 1685 and 1700. So sort of like in the silver chart, $20 is kind of a big psychological, technical level. Gold, I would say it's more of a range between 1685 and 1700. So far, even with Friday's weakness, gold is still holding 1700 on the futures. So that's a positive sign. That's a positive sign. And just like I said with silver and the gold miners exchange traded fund, we should start to see gold move up again by the end of next week. If this really is a major price low, we shouldn't see an extended pullback here. Bob Moriarty. So, this is a good blog post, but basically at the end of it, he makes the point that really the best time to be invested in mining shares and juniors, especially juniors, is the first 6 months of a new bull run. Really, all the other times you're going to lose money. Really, it's like once every 3 to 5 years, the sector has a 6 or 7 month run, or maybe even it's not even 6 months. It could be like 2020, where it was like April to August. It was like 4 months or 5 months, something around 5 or 6 months. It has these runs, and these bull market runs uh, see the average junior mining stock go up like 6 or 7x, and the big winners go up 10 or 20x. And yeah, it can be life changing in terms of the returns that you can get during these bull market runs. And basically, Bob is of the opinion that we're at the beginning of one of these runs again. So, food for thought. Good blog that Bob wrote, yesterday. West Dome. We talked about Equinox. West Dome. This looks like a double bottom to me, but just like I said with all the other precious metals charts, it should find support right around where it closed on Friday. If this is the real deal, then we should see buyers come in on the West Dome chart somewhere between 875 and $9 at the beginning of next week. Relative strength. This is a classic, thrust where you go, you see a thrust in the RSI up above 60, you pull back to the median line, and then you thrust again. Uh, let's see if this plays out. Again, this is a potential sequence of events, a probable outcome in my estimation, in my experience, but nothing is 100%. I don't own this one. So with Equinox, we're talking about the chart previously, a lot of concern about the fundamentals of this company is they're building a new mine. You can look through their presentation. The Greenstone project in Ontario, they're building a new mine. There's a lot of concerns that they're going to have cost overruns, and they're going to need to raise more money through dilution to pay for it. Now, I met with management a month ago at Beaver Creek. They looked me right in the eye and they say they are on time and on budget. Now, could that change at some date in the future? Yes, of course it could. But as of now, I take them at their word. If they lied to me, then I guess you really can't trust anybody in the mining sector. But so far, it seems like they are on time and on budget. Now, we're going to get another update from the company this month, and that will be important, and that will definitely affect the share price. I don't know what the report is going to say. I don't know what their Q3 looks like. No idea. I just have all the publicly available data that you can find on their website. But the Greenstone project, this is a compelling new mine. So if these numbers prove to be correct, and even if they're off by 10 or 20%, it's still one of the best new gold mines in North America and actually the world. So 400,000 ounces of gold per year, $850 an ounce all in cost, average grades of the measured and indicated above 2.3 grams per ton. Overall, this is a very large gold mine that is pretty high grade. So this is a company maker. If these numbers hold or even come close to being true, this is a company making project. I'm always open to hear other ideas and people that might have more information than I do. Again, I'm not an expert on this mine or this company, but it is the sort of stock at this valuation, being down 70% for the year, where if there is an upturn in the gold sector, this one could really run and run hard. And I like the management team. I like the fact that they have strong financial backing, helps validate the company and its projects. I'm going to wrap up with one more comment. a tweet, a CEO.ca chat comment I made last week. So number one, I own all five of these companies here, and all five of them are either in the midst of a new drill program, like with West Haven at Skunka, or they're about to start a new program, like 9 Mile or 9 Mile, Metals at 9 Mile Brook, or Ridgeline. I'll be doing so I'm not going to get into this now because this video is already way too long. But with the Ridgeline CEO Chad Peters, I'm going to be doing a space on Twitter Wednesday at 11 a.m. So simply you open the Twitter app on your phone at 11 a.m. on Wednesday morning. You should see it pop up if you follow me on Twitter. And I'm basically going to be having a conversation with Chad about the drill program that the company is commencing next week. Take a look at their presentation. We'll definitely go into more detail about why this drill program is so interesting and why I own the stock next week. So have a great weekend. Thanks for your time, and I'll see you in the trading lab.